So what we're going to cover is I'll give you a brief introduction and background to capital property funds. And then particularly we're going to talk about our property debt funds. And a big focus today will be on what we call risk-adjusted returns, which stems from a thing called the capital stack. And then secondly, we'll be talking about another side of our business, which is our property equity funds. This is where we buy commercial office buildings. This is not an offer to invest, nor are we providing you any financial advice. The other thing too is that the performance of the funds that we talk about, they're not guaranteed. For example, if you put money in the bank, such as a term deposit, it's guaranteed by the government, whereas these funds are not guaranteed and they depend upon the outcome of the underlying asset in the fund. So we were established in 2012 and we've got two locations, one being in Sydney and one in Brisbane. And as I said before, we offer two types of funds, being a property debt fund and a property equity fund. And we're going to spend a fair bit of time talking about the property debt funds and then a little bit at the end talking about the property equity funds. So briefly, what is a property debt fund? So effectively what we're doing is we lend to borrowers who provide security in the form of a first mortgage over property. And an important thing here is that some of you may have heard of a thing called private credit. The difference between property debt and private credit is that we are lending against a hard asset. For example, if somebody invested in a private credit fund that was secured against, say, capital property funds, we don't actually have any hard assets. So what we have is we have goodwill and we have cash flow, but if that goodwill or cash flow stops, there's no hard asset that you can seek recourse against. Whereas with a property debt fund, if a project doesn't eventuate as you were expecting it to, you've got a hard asset where you can sell that asset and get some cash, or hopefully cash in return. Does everybody understand the difference there between, what sometimes it's called goodwill lending or cash flow lending? We're not doing goodwill lending or cash flow lending, it's property-based lending. So there's a hard asset that we're lending against. And that asset is usually or always independently valued by an independent certified valuer. Income is derived from these returns via interest payments, and they're payable under a loan agreement. So when a borrower signs up, they will have a coupon that they have to pay every month or every quarter. And I'll come back to that point in a moment. Currently, investor returns around about 10.5% paid quarterly. So the other thing we'll spend a little bit of time on is that people immediately think these must be borrowers of last resort. So we're going to spend a little bit of time talking about the style of borrowers we lend to and our lending philosophy. So the 10.5%, it ranges between 10 to 10.5%. That would be for a first mortgage, up to 65% LVR. Does everybody in the room understand what an LVR is? What it stands for? Some not. So, okay, I'll tell you. LVR just means loan to valuation ratio. So, for example, if a property is valued independently by an independent valuer for $100, and then we lend $65 against the value of that asset, the loan to valuation ratio is 65%. So in order for us to lose any capital, the value of that property would have to fall below $65 in value before you would be unable to recoup your original loan amount. So that's what an LVR means. So generally, the lower the LVR, the better. The investment term for our debt fund is 12 months, typically, and the minimum investment amount is $50,000. As I said before, so income is paid quarterly, around about 10%. The other thing too is that the directors of capital property funds co-invest into every opportunity that we present. So not just the lending opportunities, but also the property opportunities. Our philosophy there is that if we can't invest in it ourselves or don't believe in it, it's difficult to ask investors to invest in it as well. So we say, would we put our own money into this opportunity? And if the answer is not yes, then we wouldn't promote that to our investors. So most of our loans are secured via a first mortgage over property, and occasionally we offer a second mortgage opportunity. Now, we only offer a second mortgage where we are the first mortgagor, so we're behind ourselves. And I'm going to talk about the differences between a first mortgage and a second mortgage in a moment. Currently, the loan book is around about $100 million, which sounds like a large number. So we wrote about $100 million last year. So we would be an emerging, what they call non-bank lender. So there are lending books that are much bigger than ours. The benefit of having a small lending book is we've got a very good connection with all the loans, and there's very good transparency across the loan book. This year we'll probably write about $150 million, so a little bit more than what we wrote last year. And the average loan size is between $5 to $15 million, sometimes a little bit more than that, but not much. And just to dwell on that too, the $5 to $15 million they're what we call, they're doable deals. So it's not a $100 million loan or a $150 million loan. If something goes wrong, we can step in and finish the project. So, they're usually a land subdivision or a refurbishment of an aged care facility or building a childcare facility. So they're not huge, large and complex projects that are difficult to complete if they get into trouble. Okay, we're going to talk about risk-adjusted returns and what is the capital stack. Does everybody know the difference between a first mortgage and a second mortgage? Everybody does? Okay. Some people don't. The difference is say that an asset's been valued or a property's been valued for $100 and a borrower wants to borrow $70 against that asset. How we would do it at Capital Property Funds would say, look, we'll lend you $65 as a first mortgage and we'll lend you the other $5 as a second mortgage. And there will be there's different risk because the LVR, the loan to valuation ratio, is slightly higher, and there's different risks and there'll be a different rate of return. But what happens if the property has to be sold? The first mortgagors are repaid in full, or they have to be repaid in full. And once they've been repaid in full, second mortgage holders are then repaid if there's any funds left over. So if you had an asset that was worth $100 and it had a first mortgage at 65 and the second mortgage was at 70, if that asset fell down or decreased in value to below, say went down to $68, the first mortgage holders will be repaid in full. Then anything left over will be used to repay the second mortgage holders. So that's the difference between a first mortgage and a second mortgage. And here you can see we have a diagram called the capital stack. So generally what we talk about here is the higher the risk, then the higher the return should be. So this stems from what we call the risk-adjusted return. So we're really big on making sure that you're getting an adequate return for the risk that you're taking. So here with a first mortgage, it's lower risk than a second mortgage, and then what sits on top of a second mortgage is equity. So equity is just another word for a way of saying ownership. So for example, when most of you probably would have bought a house, borrowed some money from the bank has a first mortgage. Say you bought the house for $1 million, first mortgage was $600,000 or $700,000. The equity is the component of the home that you own. So you can sit anywhere in this capital stack, but just make sure that you're aware of where you sit and that you're getting an adequate return for where your position is in the capital stack. So at the moment, where we're pricing the capital stack, we're pricing first mortgages up to 65% LVR. LVR, we spoke before, means loan to valuation ratio. So a property would be independently valued and we'd lend up to 65% against the value of the property. And at the moment, we're generating or providing a return to our investors, and this is net of all fees and expenses, of actually probably really more 9 to 10.5%, depending on the LVR. We also do second mortgage investments. And as I said before, I think some of you may have seen the one at Paddington we did recently. So that was a 72% LVR. So we did the first mortgage at 65%, and then they wanted a little bit extra as a second. And so that was paying 18%, but it was higher up the capital stack, but it was a higher return. And you'll notice too that when we say we've got here a per annum return, so with a first mortgage and a second mortgage, there's a loan agreement, and that loan agreement dictates the return, the rate of return that the borrower must pay. We do also offer equity opportunities where you can sit alongside the developer and take an equity holding in a particular project. And obviously these are higher risk type investments, but they do have slightly higher returns. So we've got here is 30% return, but we don't have a per annum there. So if the opportunity gets delayed because there's been a lot of rain or they can't get on site and complete the project, you might still get your 30% return, but it might have taken 2 years to get there. So that's a 30% return, but it's 15% per annum. So there's more risk. So I'm just talking about our lending philosophy. Our number one philosophy here at Capital Property Funds is what is the repayment strategy. So it's very easy to lend money. The hard bit is getting paid back. I'll come back to that. And number two, it's all about the people. So we believe that good quality people have good quality projects. So we like developers where they've got experience, they've got an integrated team, so they've got a marketing team, an origination team and a project management team. And particularly we like it when there's a close connection between the origination team and the project marketing team. The reason being, just as we say, it's very easy to lend money, the hard bit's getting paid back. It's also very easy to buy a block of land. The hard bit is to sell the completed product at the back end. So before a developer would buy, originate or purchase a block of land, their marketing team should be very much involved to make sure, can they sell the project? Do they know who they're going to sell it to and how they're going to sell it? If they can't answer those questions, generally they don't buy the property. So we like experienced developers that have their own internal marketing team, origination team and project management team. Typically they've been working together for a long period of time. Again, and the other thing too, we like repeat borrowers. So our philosophy is the most risk is when you lend to somebody for the first time. So ideally what we want to be able to say is that we've known this person for 15 to 20 years, we've lent to them on previous occasions, and there's less risk. So we like repeat customers. And this will stem back a little bit to our lending philosophy. So most, if not all of our borrowers have been known to the lending team for over 15 years, and we've successfully lent to them on previous occasions. And if you look at most loan agreements in Australia, it's a very one-sided affair. So it's almost a master-servant relationship. So mortgage, mort means death. So a mortgage is a death grip. So it's very easy. A lot of our competitors, I suppose, regard the mortgage agreement as a master-servant relationship. And it's about finding that happy balance, is that our view is that we want our borrowers to be very successful. If they're successful, they can complete the project and repay our funds, and then they can come back and borrow again for their next project. An example of that would be, and I'll go into a little bit of detail here, is we have a land subdivision at Bow Desert in just west of Brisbane, and we lend money for them, and they'll effectively be a cow's paddock. And then what they do is they divide the cow's paddock up into individual lot titles, and that takes around about 6 to 9 months. And then they sell the individual lot titles to repay the money, to repay our funds. Now, in order for them to be able to sell the individual lot titles, the titles have to be issued by the Land Titles Office. And to get them issued, you have to have what's called a sealed plan. So you've got to complete the development in accordance with the DA. The council has to sign off to say, yes, they've done the development and they've complied with all the conditions of the DA. Once that plan has been sealed, then they walk down to Land Titles Office and they get the individual lot titles. So it's really, really important that our borrowers get their individual lot titles issued as quickly as they can, because the sooner they get their individual lot titles issued, the sooner they can start selling the completed land lots and repaying our money. So it always comes back to easy to lend the money, hard bit's getting paid back. A long-winded story, I know, but we had an example where a borrower was doing a land subdivision in Spring Creek, and there was some subsidence in a road. So he'd built the road to the council specification, The road hadn't met that specification, so council wasn't going to sign off on it. Now, another lender, could put that borrower into default and refuse to put any more funding into the project, and they'd have to go and fix that problem themselves. It's not a philosophy that we would adopt. We believe that puts more risk into the portfolio. So our philosophy was, look, they've acted in good faith. They've done nothing wrong. Maybe the specification wasn't correct. So we advance the funds. They pay a fee for doing that, but we advance the funds to them in order for them to fix the project. Then the plans get sealed, the titles get issued, and then we start getting repaid. So that's just sort of our philosophy. So that borrower is very, he's successful, we're successful, and he'll come back to us to borrow funds again down the track. So it's about having repeat customers that they're a known entity, there's less risk with them. And as I said, it's not a master-servant relationship, it's a partnership with our borrowers. The other thing we do, which we mentioned earlier, is that, look, we co-invest into every opportunity that we offer to our investors. And again, I mentioned before, look, if we can't put our own money into it, how can we ask our investors to do that? And number 4 is just the metrics. So typically the loan terms are generally 12 months. They generally don't go any longer than that. For a first mortgage, the loan to valuation ratio is up to 65%. And the market that we particularly like is Southeast Queensland. And that's really a triangle from Noosa to the Gold Coast and west to Toowoomba. So anywhere within that arc, we're very, very comfortable lending into that space. We do a little bit in Sydney as well. The reason too why we like Brisbane, and you'll see some videos in a moment of some projects that we're doing, sorry, not just Brisbane, but that southeast corridor, is, look, it's beautiful stock. So you've still got a lot of undeveloped land in southeast Queensland. So the quality of the stuff that you're lending against it's quite beautiful. So you've got particularly rural residential type blocks where there's a lot of wildlife, etc., or even emerging estates where there's a lot of amenity. Whereas it's more difficult to do that style of lend in Sydney and or Melbourne. The other thing too, the dynamics of the southeast Queensland market are very, very strong. So they've got very strong interstate migration, very good employment, and with the 2032 Olympics happening, there's a lot of infrastructure being spent in Brisbane. So it's a very buoyant economy. The other thing too with the metrics is we spend a lot of time pricing the loans to make sure that there's an appropriate return for the risk that's being taken. So we'll just have a look at a recent opportunity that some of you in the room may have even invested in and be a little bit familiar with. This is one that was a guy that we've known for 15 years. He's a highly credible counterparty, very good quality developer. We also get personal guarantees from the borrowing entity. And one of those guarantors is a high net worth individual who would be probably one of Queensland's top 100 wealthiest people. As I said before, a very professional developer with a credible in-house marketing and development team. So they've been working together for over 30 years. I mentioned this, we've lent to them successfully on many occasions. We've known them for a very long period of time. On top of all of that security, you also have a first mortgage security over property, which is your primary security. And this was a stage 3 and 4 of an estate that they were developing in Beaudesert, which is just west of Brisbane. They've already gone through 1 or 2 stages and had 100 comparable sales. So we sort of felt that there was a really good market and a proven market for the quality of the stock that they're developing. And I'll just talk a little bit too about their philosophy too, is that this particular developer will only sell the completed stock to owner-occupiers. The reason being is that he's got 1,000 lots to sell, so it's about a 90-hectare block of land, and he wants the quality of the estate to be quite high. And so his philosophy is that investors, where they buy the property and let renters come into the estate, they don't take as good care of the property. So they don't mow the lawns, there's cars parked on the verge, they don't look after the house as well. So he will only sell the completed stock to owner-occupiers. And his philosophy there, and it's proven to be true, is that in stage one of the development, he was selling the blocks of land for around about $150,000 to $160,000. And then in stage two, they went up to about $200,000 to $220,000. I think stages 3 and 4, we'll see a little video on it in a moment, they're sort of now around about that $300,000 mark. So the more that he can get for the blocks of land, obviously the more money he makes. And then also people want to come into the estate because it's a desirable estate, and also they come in because maybe they can create a little bit of wealth for themselves. So it becomes sort of a self-fulfilling prophecy. So he only sells to to owner-occupiers. He also has a relatively strong covenant over what type of building can be built within the estate. So every single home that's built within the estate needs his sign-off and approval. And there's a certain type of building that has to be built. For example, you have to have 2 types of textures on the front facade of the home and other things. They also spend more money on landscaping, so they repurpose some of the mature trees within the estate and replant those. All of the retaining walls within the estate, they're not Besser brick, they're they're locally cut sandstone. And also he will not let external agents sell his finished product. So he has his own internal marketing team they've been with him for over 30 years. And then the other one we're going to have a look at too is Sanford Rise. So if you look at Spring Creek, we've got 2 little videos we'll show. So Spring Creek is 400 to 500 square metre blocks of land. It's affordable. You could get a house and land package for sort of $600,000 or $700,000. Then we've got Sanford Rise, which is a completely different style of product. So it's what we call rural residential style. So they're 4,000 to 7,000 square metre blocks of land. You've got creekside or parkside lots. There's kangaroos, there's koalas in the trees. You're very, very close to relatively close to the Brisbane CBD. But they're selling for around about $1 million per block. So with this particular developer being at Sanford Rise, again, he's been known to the lending team for over 15 years. This one, it's a 10.25% rate of return. The loan-to-value ratio is 65%. Again, he's a professional developer with a very credible in-house marketing team. Again, they've been together for probably over 30 years. And what we'll do in the video that you'll see, you will actually see there's an interview with the in-house marketing person talking about they specialise just in doing rural residential. They know the market very well. They know the wants and needs of the market. So they're very selective about what they build, and they're very good at it. And again, as I come back to, with all the security, it's a first mortgage security.
Spring Creek is going really well to date. We're just about finished stage 8, which you can probably hear the trucks behind you. A lot of that's already sold, about half of it. We've got nearly 30 unsettled contracts at the moment, which means that stages 3 and 4 are fast running out of land, and those that have invested there will probably have their money back sometime this year. And we'll be hoping that they'll invest again in stages 5, 6 and 7, because we're going to have to ramp up production to stay in line with demand at the moment, which is at an all-time high in Queensland. Our current LVR across this project is only a touch over 48%, which is considered more than safe. We started at $149,000. I just had a meeting with Tony this morning, and we're going to raise our minimum price now to $299,000. But we are selling blocks now in the high 3s. So I think by Christmas time, we'll probably be touching $400,000 a block here, which is a massive price growth. And for those who've invested in the estate, it should put a big smile on their faces, really. We invest a lot of money and time and effort into making sure that everyone who buys from us is looked after financially, emotionally. The majority of our buyers here are over 60 and they're coming out of the Gold Coast because this is a safer place to live, it's a quieter place to live. It's still within an hour of two major capital cities, Gold Coast and Brisbane. It's seen as a really nice place to live, both in terms of the views, the amenity. We've put a lot of work into our park. It's not a traditional park. The trees that you see there will not be little. They're good big trees, but they're all trees that have been here since the day they were planted. We've just moved them around. We've used sandstone blocks for people in conversation type pit. It's a place for relaxation and a bit of contemplation. I was just talking to Tony, our sales manager, and I think he's just sold the first $900,000 house in Spring Creek. 3 years ago that would have been unheard of. The average price here was probably $550 to $600. Now it's more like $700 odd, and we are seeing homes being built here now that'll soon go through the $1 million mark. There's a very strong market for established housing, but new established housing, not second-hand housing. People want a new house, but they want it now. We're trying to provide that stopgap in between, where we can always have about half a dozen houses that are either finished or within 3 months of finishing. And people seem to be really responding to that. I don't think we can build them quick enough at the moment. So South East Queensland has the highest house growth rate in the country, and we have the highest demand for immigrants wanting to come into the country, want to live in this area. So the stars are aligning for us, and I'm happy they are, because I've been in this industry nearly 40 years, and there's plenty of times when they don't align. So yeah, we're going to make hay while the sun shines.
And so some of you have invested in that, and this is a 1,000 lot subdivision. So at this stage, they've built around about 200 lots approximately, and there'll be other stages coming down the track. So again, a very good quality counterparty, a terrific project, and you know, not a borrower of last resort. I just want to now go on to another one.
We're here at Sanford Rise today. We're about 4 weeks from completing civil construction. We made a major milestone last week with the finalisation of the asphalt road and driveways. It's been a long process due to weather and some other technical problems, but we're finally here, and we're very pleased with how the estate's come up. So we've created a central main cul-de-sac and then a shorter cul-de-sac as well, which has allowed us to get almost every block rising up from the street, and also step the blocks to take advantage of the magnificent views within the Sanford Valley. Within the estate we have 19 blocks of land, including the original house from the property. So all the blocks are 4,000 square metres, or 1 acre blocks in the old language, and that really just gives people a sense of space and privacy. Prices range from $950,000 to $1.45 million. We'll be building 3 spec homes as well after we've finished civil construction to diversify our product offering. We're looking at somewhere between $2 million and $2.5 million for the brand new house and land packages. Due to the weather in South East Queensland over the last 12 months and some factors on site like rock, you know, the civil construction timelines here are longer than we had anticipated. So we've had to go through a refunding process with capital property funds. It's been a simple process, where if we had to go through that with a traditional bank, may have been more complicated. Sanford's one of the dress circle country regions in a stone's throw of Brisbane. It's about 35 minutes from the heart of the Sanford village to the Brisbane CBD. The village itself has a real country village feel with a pub, cafes, restaurants and all the amenities, schools, shops, medical, everything. So it's a real village feel. So it really is that country life a stone's throw from the Brisbane CBD.
we talk about repeat customers. So with Spring Creek, that stage 3 and 4 is now complete. It's all the construction's done. It's just in sell down mode. So of that stages 3 and 4, there was 81 land lots, and they'll sell down quite quickly. A different market, obviously. They're selling blocks of land for 300,000 or something, and they're sort of 600 square metre blocks of land. With Sanford, they've had one thing, southeast Queensland, it rains a lot there, so they've had a few rain delays, but they've effectively now reached practical completion. So there's 19 beautiful land lots at Sanford Rise. As I said, they'll reach practical completion fairly soon, and then we will extend that loan for another 12-month period and give them some time to sell down the completed stock. So what I wanted to, a common question we get is that these guys must be borrowers of last resort if they're paying 10, 11, 12% to borrow from us. And I used to have a whole lot of slides here where I did some complex calculations, but I just want to talk to it is that, look, the reason that they come to us is that in short, they make more money in a shorter time frame coming to us than going to the bank. So they can go and borrow from a bank, and I'll use Terry as an example, and they might save several $100,000 in interest expenses. So they're paying 10, 11, 12 from us. They might be paying 6, 7 or 8 from the bank. The difference is if I use Spring Creek, and I'm going to weave in a little bit about risk as well, but if we look at Terry, we funded that. Originally it was I call it a cow's paddock. It wasn't a cow's paddock. It was a Catholic church facility. Actually, it was a home for wayward boys called Boys Town. And we funded the acquisition of that land, and then he had a master plan approval for around about 1,000 lots. And when you're starting a development, particularly one that's going to be 1,000 lots, the most risk is in stage 1 because everyone just sees a cow's paddock. No one's got any imagination. Is anybody going to, no one will start buying until they can start to see tractors on the ground, land lots appearing, activity. Then you find all the sales come at the back end. So as a lender, you want them to complete that stage as quickly as they can to de-risk the project and to move on to the next stage. So if Terry had have gone to the bank for funding, they would have said, yeah, we're very happy to fund you, Terry, but of the first stage, which is 50 lots, you're going to have to pre-sell a large proportion of those 50 lots. So instead of selling them for, say, I should have used Sanford because that was only 20 lots, the maths are a bit more simplistic, but instead of selling the blocks of land for $200,000 per block, he has to pre-sell them, say, at 150 or 140, so he gets less total revenue, and it would take a long time to do that. So he might take him 6 to 9 months to get the pre-sales required, and then he would start construction. So it would take him, instead of a 12-month turnaround, it might take 18 to 24 months to get the stage completed. So it takes him a longer period of time, and then he makes less overall gross revenue. But he saved a little bit in interest costs. So they make more money more quickly by coming to a non-bank lender like ourselves. And the other thing too, which I come back to the risk, is that what Terry's doing when he's doing stage 1, he's got his eye on stage 2. So he wants to start stage 2. And again, the more that you can progress through an estate, the less risky it becomes. So we're now like at stages 3 and 4. We're very, very comfortable with it. It's got 200 comparable sales. It's a proven estate. We know that the product that he's making, people want to buy. But when you're at stage 1, you don't have that same feeling. So we want him to get into stage 2 as quickly as he can. Typically, if he borrows from a bank, every time he sells a block of land for $100, they take 100% of the net sale proceeds until that loan has been repaid in full. Therefore, he's got no funding or cash flow to start on stage 2. Now with us, provided that the loan is performing, and maybe for the first couple of sales we might take 100% of the net sale proceeds, but once we're comfortable with where the LVR is, we might take 65% of net sale proceeds. So that gives the borrower some cash flow to start getting works approval and planning approvals for stage 2. So when stage 1 finishes, bang, he rolls into stage 2. So by coming to us, they make more money, they make it more quickly, and they can roll into stage 2 more quickly and get the sales happening more quickly. From our perspective, and I think from the borrowers as well, there's less risk as well, because getting the estate built and sold is very important. So look, I hope that all makes sense. That's sort of why they come to us. So if we look at Samford, I think for mathematical simplicity, let's say there's 20 lots, because my maths isn't very good, and if he's selling them for $1 million a pop, there's $20 million in gross revenue. If he has to pre-sell them at $800,000 a pop, you know, he's lost, what's that, 2 2s are 4, is that $4 million in lost gross revenue? And it probably would have taken him twice as long to get there. So he can come to us, he pays a little bit more in interest expense, but he'll make more gross revenue in a shorter time frame. And also too, we're probably more flexible and easy to deal with. So if we look at Samford, so it's still within a comfortable loan to valuation ratio, we're very, very comfortable to give him a 12-month period to sell down that stock. And what he'll do is he will run an advertising campaign on regional television in Queensland. And if you're going to spend $1 million on a block of land, you want to walk the site, get a feel for it. You want to be sold to by the marketing person. And instead of getting $1 million a pop, he might get $1.1 million a pop for a couple of blocks as well. So he might even make more money than he's anticipated. So that's our lending philosophy, and that's sort of why borrowers pay, you know, higher rates. They're certainly not borrowers of last resort. They're professional, integrated developers that are very good at what they do. Yeah, so look, here's just a quick summary. So, you know, more profit, less time, less headaches. When I spoke about the subsidence in the road. The other thing too is that they can get onto the next stage more quickly, which we like as well. You know, as an estate develops, prices tend to increase as well, so he can get access to higher profitability, and as he has a quicker path to higher sales prices and more profit. And as I said before, as the estate gets built out, the risk becomes lower. So it's in our best interest, if we're going to be a long-term funder of this estate, to get it built out as quickly as possible. And as I said before, we want a repeat customer, so we try to have a good working relationship with Spring Creek, and that stems back to, it's all about the people. So we want to get good quality people onto the lending book, and we want to have a long-term relationship with them. We think there's less risk there. And I think I've just summarised that as well. So, you know, with David, I mean, we had 3 projects with him more recently. We've done other projects with him. We've got 2 with him at the moment. Excuse me. And one of them is in sell-down phase, and Samford Rise has now just reached practical completion, and it'll go into the sell-down phase in the next 12 months. Just to talk about some of the lending opportunities that we have available at the moment. So we have one in Paddington, Queensland. Is anybody familiar with Paddington in Queensland? A few hands, okay. Yeah, so if you know, it's quite uncanny. Paddington, Sydney and Paddington, Queensland are very, very similar. So 30, 40 years ago, Paddington in Brisbane was a working class suburb. It's now become gentrified, so, you know, tree-lined avenues, beautiful cafes, restaurants, boutiques, very close to the city. It overlooks Suncorp Stadium, so you can have a meal and toddle down and watch the footy. This particular loan, it was actually the second has been sold out. So that there was a second there. They wanted to borrow 72%, and so which we lent to them. So the first is at 65, which is still open. What we like about it is these borrowers own about a dozen income-producing premises on Given Terrace, Paddington, which is the main road through Paddington, and so if we need it, we can garnish that rental income off those income-producing premises, and they're building a childcare centre behind one of the premises. So that one is open at the moment. We've also got another one at Bly in Caboolture, which is paying 10.5%, and that's a 60% LVR. And people might say, well, why am I getting a higher rate of return for a lower LVR at Caboolture? And it's a very good question. The chap at Caboolture, and it's just a land subdivision, it's going quite well. We've never lent to him before, and he wasn't as experienced as the guys from Paddington. The quality of the real estate at Paddington is very good. There's also income support from the income-producing properties, so we felt that was an appropriate price. But Blyblay and Caboolture, that's a 5-month term. It's got 5 months to go. We've also got one at Mullaney, which is on the Sunshine Coast. Beautiful area. That is a land subdivision. Everyone understands the difference between when I say no built form development. So with a land subdivision, all you're doing is putting in curbs, guttering, sewer, electricity. You're not actually building any houses. So there's what we call, there's no built form development. So it's just bulldozers pushing dirt around. So most of these are land subdivisions. There's no built form development. So that one has a very low LVR of 25%, paying 9%. And then we mentioned Samford. So that one is paying 10.25%. A very good quality. It's virtually reached practical completion. They've had a few delays due to rain. So if anybody's interested in any of those, feel free to contact the team. And I now want to talk about, to change tact completely, is we were talking about debt before, and I now want to talk about, equity, which is when you buy a building and you become the owner of a building. And so if the building goes up in value, you can enjoy an uplift in value, like being an owner of an asset. So typically what we buy are commercial office buildings between $30 to $60 million, maybe a little bit higher than that, but we want to buy institutional grade assets that would fit the mandate of a large fund manager. So again, as it's easy to lend money, it's hard to get repaid. It's easy to buy a building, but you want to know who you're going to sell it to at the end of the holding cycle. The income return from our property funds is derived from a rental income. So generally buy a good quality building, and then they have a rental agreement. And our philosophy is that we typically buy A-grade buildings, and I'll talk a little bit about the difference between an A-grade and a prime grade asset in a moment. But A-grade buildings tend to have A-grade tenants. So and A-grade tenants tend to pay the rent, and they don't tend to go bankrupt. And then the other component of your return is capital growth over the medium to longer term. So the return is principally derived from income, but you may also get some capital growth, and I'll talk about that also. And the investment terms are a bit longer. They're generally 3 to 5 year terms, not 12 months terms. And the minimum investment in the property funds is around about $25,000. So typically we like to buy income producing buildings located in CBD or near CBD markets. Again, when I said, with our lending opportunities, we co-invest in every opportunity. We say, well, look, if we can't put our own money into an opportunity, how can we ask our investors? Similarly with our office buildings, our philosophy is, would we be happy to have an office in this particular building? So we're really big on 4 sides of natural light, and I'll come back to the 4 sides of natural light. Has other benefits as well, but we want to have nice views, 4 sides of natural light if possible, and proximity to tenant amenity. So at lunchtime you want to be able to, do a bit of shopping, go to the gym, do your banking, catch up with a friend for a drink after work if you want, and be able to catch a bus, train or ferry fairly easily. So that's what we call proximity to tenant amenity. And people want to rent, if you've got a good building that's well located with proximity to tenant amenity and it's affordable, then it'll always lease out. So typically what we're buying is, you've got your prime assets, which are the shiny glass tower in Barangaroo. The rents there might be $2,000 a square metre. Typically what we want to buy is the sub-prime asset. So typically they're called A or B grade assets. So they're very good quality assets. They'll have a floor plate of around about 1,000 square metres, proximity to tenant amenity. So they're pretty good buildings. You've got lots of natural light. You can, you're in the thick of it. So you can get to the bus, train or ferry, good restaurants, cafes, do your banking, go to the gym, but you're not spending $2,000 a square metre. And the other reason why we love buildings with 4 sides of natural light and 1,000 square metre floor plates is that 60% of commercial leases in Australia are below 600 square metres. So if you've got a building with 1,000 square metre floor plate, you can divide that floor plate in half and put in 2 suites. They're going to have heaps of natural light, and it's going to have a big appeal to the bulk of the market, which is that sub 600 square metre space. So that's typically what we look for. Typically we're aiming for an income return of around about 8% and the potential for capital growth. And the other thing we like to do is we like to buy buildings that aren't fully occupied. So where the term we use in this industry is called leasing risk. So we like to buy a building that's 80% occupied, and every single building that we've ever acquired, we always get a 2-year rental guarantee from the vendor. So what that does is you might buy the building for $60 million, and then the vacancy over a 2-year period might equate to, say, $2 million. I'm just picking a figure, but generally it's around about $2 or $3 million. That $2 or $3 million would be paid back by the vendor, usually into a trustee account. And then so for the first 2 years of ownership, the buildings are 100% occupied. So it's generating very good quality income. And then the strategy we use, it's very, very simple, is we engage with local leasing agents and we put in what's called spec suites, speculative suites. So if you've got trying to rent out a building and there's wires hanging from the roof, it's all dusty, there's old computers in the corner, it's very difficult we found it very difficult to lease those spaces. But if you can cut it up, talk to the local leasing agents, find out what size suites are in demand, get interior architects and designers and put in really good quality spec suites. So there might be some polished concrete with a snazzy kitchen, really good quality offices, nice pot plants, etc. You find they lease very, very quickly. It's a really, really simple strategy, but it's just worked for us for many years. And the other thing too is that if you can increase the leasing profile of the building, we call that manufactured growth. So you're going to get 2 types of growth when you own a building. You'll get market growth where sentiment turns and the value in the building uplifts. You get an uplift in the value of the building because of the market sentiment. You can also create manufactured growth by increasing the leasing profile. So, for example, if you buy a building for $100 and it's generating $10 a year in income, it's worth $100. But if you can get the rental income up from $10 to $12 or $13, prima facie, the value of the building will go up, and also the amount of income that you can distribute to your investors goes up. So we call that manufactured growth, is where you improve the leasing profile. The other thing we do is we decarbonise the building. So we might improve the chillers, so that reduces electricity costs, upgrade the lift landings, foyers, etc. And we're also now looking at putting in solar panels and batteries where you can reduce the electricity cost of the building, which is a benefit for tenants. And also that we're finding now that tenants are wanting to have a component of their electricity that is carbon neutral. And also too, where we are at the moment, and this is our house view, is that property is cyclical, and we see an opportunity where you can, at the moment, buy buildings below replacement cost. So if you can buy a building for $100 and for someone to build that same building would be $110, you've got an irreplicable economic advantage when compared to newly built. So at the moment you can buy buildings below replacement cost. As I said before, we then you can buy them below replacement cost, reduce the carbon footprint. I mentioned a few things before. This is all standard stuff in using intelligent building management systems. Example of that would be, and we did this on a building in Parramatta where the lights in the car park are on 24 hours a day, 7 days a week. You just put in sensors so that the lights go off unless there's somebody walking in the car park, and that'll reduce your electricity drain. Energy efficient lighting, end of trip facilities. Simply that means having a secure storage for your bike, lockers, change rooms, so people can ride their bike to the office, put it in a secure facility, have a shower, get changed, then go to work. And then I mentioned the particularly chillers, air conditioning units. I'm not an engineer, but we get external consultants will improve. You find that the air conditioning facilities in buildings are generally dated. You get very big improvement in efficiency in the air conditioning units by upgrading those, and also solar panels and battery systems. And then the manufactured growth, again, can also be created by increasing the leasing profile, and I spoke about that as well. And then the other way that you can get a return is if market sentiment turns. And so what we're sort of saying is that probably most people would agree that we're probably at that peak of that interest rate / inflation cycle, and that we don't have to guess when it's going to come off, but probably the next move down will be for interest rates, the next move for interest rates will be down. So when interest rates come down, that will increase the value of commercial office buildings in two ways. So as I said before, if a building is generating $100 in net income, then if its interest expense is reduced, instead of having $100 in net income, it might have $110. So you've got more income that you can distribute to your investors. But also you'll get an uplift in the capital value of the property as well. So we believe that now is a good time to be acquiring commercial office buildings, a little bit counter-cyclical. You can buy them below replacement cost and then hold to enjoy an expected uplift in the next sort of 12 to 18 months. So just to recap on some of the things I was talking about is that every building that we've ever bought has 4 sides of natural light. So you can walk around the building in its entirety. And the reason we like that is, look, there's a lot of amenity, but also you can easily subdivide the floors into smaller suites. And as I mentioned before, that most leases in Australia are done in that 600 square metre space and below. We always acquire a building with an occupancy of between 70 to 80%. And the aim there is to create manufactured growth. As the net income of the building improves, so does the value and so does the distributable income. Every single building that we've ever purchased, we always acquire it with a 2-year rental guarantee, which is paid as a lump sum cash payment by the vendor. And this provides, we call that term de-risk, so that you've got 2 years where the building is 100% income producing, and in that 2-year period, you improve the leasing profile as much as you can. And look, this is probably the most important point, is proximity to abundant tenant amenity. If you've got a good quality building that's well located and close to amenity, it will always lease. If you've got and it's something you can't change, if you've got a building in a remote location that is not in proximity to tenant amenity, and it might be a lovely A-grade or prime grade building, it's very hard to lease those buildings out. Look, the other thing I'll talk about too, and I'm probably getting into the minutiae, is that we like diversified tenancy profiles. The reason we like diversified tenancy profiles is that if you had a building that had a 10-year lease to Telstra, for example, and there's only, you buy it when there's 10 years on the lease, but in year 8, when there's only 2 years left on the lease, it might be a terrific time to sell the asset. But nobody's going to buy that asset because all the value in the asset is tied up in the leasing profile. So that's one of the things we don't like about buildings with just one single tenant, is you don't have any control over the timing of the disposal of the asset. But if you've got a diversified tenancy profile, it's always going to have a 3 to 5 year, what they call weighted average lease expiry. And the other thing too is that we like affordability. So we're not buying the shiny office tower, we're buying the subprime asset, which is an A or B grade asset. And look, they have A or B grade quality tenants. What you'll find too is that you'll get a slightly higher yield. So if you buy a building in Barangaroo, and I'm not poo-pooing those sort of assets, they're very good assets, the income yield off those assets will be lower. Instead of being a 6 or a 7, it'll be a 4 or a 5. Whereas we think, we're looking to provide a higher yield and a higher total return. Yeah, and if I look at the affordability, sort of, that 450 to 650 per square metre is what we look for. And we've got a good track record of managing this style of asset. And some of you in the room may have invested in Parramatta. Did anybody come into Parramatta? Yeah. Okay, good. Yeah. So with that one, and I'm cognizant of running out of time, but that was a building that we purchased for $30 million in Phillip Street, Parramatta. And you can walk around that building in its entirety. So it had 4 sides of natural light. It had an 80% occupancy, and we acquired that with a 2-year rental guarantee. And the floor plates were 1,000 square metres. And so what we did is we improved the leasing profile from 80% up to 100%. And then we sold that asset after a 3-year holding period for $56 million. So we bought it for 30, sold it for 56. It was an unusual one, I must admit, because there was manufactured growth, which we spoke about, so solving for the leasing risk. And then you've got market growth, where the market just turned. So Parramatta had a little bit of a very good run. So during the 3-year holding period, the investors enjoyed income of 8%. And the thing too, it was a stabilised asset, so we bought it and it was in pretty good nick. It had KPMG, Knight Frank, New South Wales government, some big insurance companies. We didn't really have to do a lot to it, just had to solve for the leasing risk. So it was what I call a stabilised asset, generating very good quality income, and investors more than doubled their capital in that particular asset. And this is another asset that we bought in Coronation Drive in Brisbane. Now, again, this asset has got 4 sides of natural light. You can walk around the building in its entirety. It has 1,000 square metre floor plates, and it was acquired with an 80% occupancy, again with a 2-year rental guarantee. And you've got lovely views of the Brisbane River, Brisbane CBD. You've got the ferry out the front. You've got the train station behind, and you've got a bus network on Coronation Drive, which you can't see. And you've got very good, there's very good pubs, restaurants, cafes all around Toowong, so it's very good proximity to tenant amenity. Now, until recently, so it's currently valued at, it's 100%, actually it vacillates between sort of low 90s to 100% leasing profile. It's valued at $53 million, and for the last 7 or 8 years, it's distributed income at 8% per annum. At the moment, it is still generating very good quality income, but it's not distributing that income. It's being retained by the fund because we're trying to negotiate settlement terms on another asset that we're trying to buy. But the thing about Brisbane too is that if you're not aware of it, it's probably the best performing office market in the country. So you've got very strong interstate migration into Brisbane. So you can, primarily that's driven by a number of things, but affordability. So you can buy a house in Brisbane for a half to a third of the price of a house in Sydney or Melbourne, and you can still earn a very good income. The other thing too is that Brisbane is one of the only 2 cities that has been given a 10-year head start on the Olympics for 2032, and 95% of the Olympic infrastructure will be built within a 5-kilometre radius of the Brisbane CBD. So all those consultants and engineers, etc., need to be located in close proximity to the CBD. So there's a lot of demand for office space in Brisbane, and because of inflation, it's been very expensive to build. So there's not been a lot of new office stock come out of the ground in Brisbane. So at the moment, we're seeing good rental growth in this particular asset. So by way of example, there is a tenant on the second top floor called Cash Converters. It's their head office, and they've signed a 10-year lease at $620 per square metre, whereas this time last year we were doing lease agreements at around about $550 per square metre. So we like the Brisbane market. And this again is another asset that we're trying to negotiate settlement terms on. Again, this is in Pirie Street, Adelaide, and it fits the profile. So it has 4 sides of natural light. You can walk around the building in its entirety. It has 1,000 square metre floor plates. It has a 70% occupancy, and it will be acquired with a 2-year rental guarantee on any of the vacancy. The other thing we like about Adelaide is if you buy a building in Brisbane, Sydney, Melbourne, Perth, you buy a building for $100, you actually have to pay $105 for that building because of stamp duty. Therefore, you don't get any capital growth in your back pocket until the building goes from $100 to $106. In Adelaide, there's no stamp duty, so you can buy a building for $60 million, and it's only got to go to $60 million and $1 before you've made your capital growth, because there's no stamp duty payable. So this particular asset will generate very good quality income. There's an opportunity for manufactured growth by solving for the leasing risk. Does anybody know Pirie Street in Adelaide, or anyone familiar with Adelaide? It's smack bang in the CBD, so very, very good proximity to beautiful restaurants. Adelaide's a bit of a foodie town. You're 2-minute walk from Rundle Mall, bus trains. There's no ferry in Adelaide, but it's a very good quality building. So guys, thanks for your attention. That's all I wanted to cover today. So if you've got any questions, we'll be staying around, or you can ask some now if you like. Thank you.